Today we're breaking down one of the most basic yet powerful tools investors use, the price-to-earnings ratio, or PE ratio. When you invest in a stock, you're not just buying a ticker symbol, you're investing in a real company. The PE ratio tells you how many years it would take to earn back your investment through the company's current earnings. If a company has a PE of 3, it would take 3 years of today's earnings to earn back your investment. If a company has a PE of 10, it would take 10 years. Let's imagine you want to start a cafe business. You find a cafe that's already running, and it makes $100,000 a year in profits. Now, you ask yourself, how much should I pay to buy this cafe? Here's how you might think about it. If you pay $200,000, you're paying 2 years' worth of profits. It means in 2 years, you'll earn back your money. If you pay $500,000, it'll take 5 years to get your capital back. Of course, companies grow, shrink, and change. The future is never exactly like today. There are other valuation methods, like the PE to growth ratio and discounted cash flow analysis. But the PE ratio remains the rule of thumb to evaluate a company's value. A company's future performance is extremely hard to predict. No one truly knows what will happen 10 years from now. The economy changes, industries evolve, and competition can come from anywhere. Focus on buying solid businesses at reasonable prices today rather than betting on uncertain futures. Investing is about buying a real business, earning real profits at a price that makes sense based on those profits. If your investment decision goes beyond this simple basis, then unless you have real insight or a real edge, you're speculating, not investing. Now, you might hear experts say, oh, different industries have different normal PE ratios. For example, they might tell you, tech stocks trading at PE of 30 to 50, or even having no profits at all, is completely normal. But here's the critical question. Should that be the basis of your investing? Or are you just playing the greater fool game, buying something expensive, hoping someone else will pay even more later? While the PE ratio is a useful tool, it can sometimes give a misleading picture if the earnings it relies on aren't genuine or sustainable. Here are 5 reasons why the PE ratio might not reflect the true earning power of a company. Number 1, one-time gains or losses. A company might report a big profit from selling a building or a business unit, but that income won't happen again. The PE looks cheap, but it's based on inflated, non-recurring earnings. 2, accounting adjustments. Companies can adjust earnings using accounting methods, like deferring expenses or accelerating revenue, to make profits look better in the short term. 3, cyclical or seasonal earnings. In cyclical industries like commodities or shipping, profits can swing wildly depending on the economic cycle. A low PE during peak earnings might be a trap, not a bargain. 4, temporary cost cuts. Companies might temporarily boost earnings by cutting spending on R&D, marketing, or staff. It boosts short-term profit but may hurt long-term growth. 5, manipulated earnings. In some cases, companies may stretch accounting rules or even commit fraud to report earnings that don't reflect reality. To truly understand if a PE ratio is justified, you need to study the company's financial reports over several years, not just 1 year. The true investor buys value. The greater fool buys hope. If you found value in this video, don't forget to like, share, and subscribe to Invest with CY, where financial wisdom turned into practical investing.